Back. The country's economy grew at a slower pace in the first quarter as power outages curbed manufacturing output and farming output contracted. Today, Statistics South Africa released growth figures indicating that gross domestic product grew at a rate of 1.3% in the first quarter of this year. This was below the 1.9% economists had generally expected. The slowdown is attributed to weak demand and electricity supply shortages. Well, companies' production lines are interrupted and at times shops have to close due to load shedding. Domestic demand for goods is depressed as consumer confidence is low. Consumers under pressure due to increasing administered costs and higher inflation. Well, export demand is also a drab as our trading partners are now struggling to grow their economies. The Reserve Bank's leading indicator, which forecasts economic trends over the 6-month period, decreased by 0.2%, and that indicates strain the economy is taking.
It's a little tricky as to whether it is basically electricity or it's a subdued demand for goods and services that the manufacturers produce. So it's early days to come to one or the other conclusion as far as electricity infrastructure is concerned. Of course, electricity as a major driver of production, when its absence means it dampens that productive sector.
Surprised to see consumer spending or retail sales and wholesale sales were quite weak, in spite of the fact that there's been quite a significant windfall from low oil prices, which has brought down consumer inflation. So it seems as if that benefit to disposable income has been used mostly in terms of paying down debt rather than boosting consumer spending. Obviously, there's also quite a lot of weakness seen in the manufacturing sector with quite a significant contraction coming through there. We think that that's largely related to electricity load shedding and relatively weak global demand during the first quarter. And then also significant weakness coming through from the agricultural sector, and that's related to a drought.
Well, unemployment in the first quarter has spiked to 26.4% after falling to a low of 24.3% in the fourth quarter of last year. More than 5 million South Africans are currently unemployed, compared to above 4 million people in the fourth quarter of last year. But this only takes into account those who are actively looking for jobs and excludes discouraged job seekers. Large quarterly gains were observed in the finance, agriculture and private households industries, while job losses were recorded in the trade, transport and community and social service industries. The number of employed people increased in the domestic work occupations, with more than 60,000 jobs created in the first quarter. Well, Stanley economist Kevin Lings joins me now for more insight on those figures. Kevin, thanks for coming in.
Pleasure.
Let's just take a look at this unemployment figure first before we tackle the GDP. 26.4%. I believe there was a new formula here, but still, the situation is dire, isn't it?
Yeah, look, 26% is way too high for South Africa's real requirements. Anything actually above 10% globally is considered high unemployment.
Yep.
So 26, even if it was at 24, it would be exceptionally high. What hurt the data this quarter was that they restated how many people are in the labor force, how many people are available to work, and that jumped dramatically. So it wasn't as if we suddenly lost a whole lot of jobs that caused the unemployment. It's more that we restated how many people could potentially work. And because of that revision, the unemployment rate looks quite a lot worse in the quarter. What I would caution, though, is even if you take that adjustment out, the unemployment rate is too high for South Africa's social demands.
Indeed. Now we look at the growth rate. We had a graph up there a moment ago, just looking at that 1.3% for the first quarter. I mean, not the sort of figure we want when we look at a figure like 26.4% in unemployment. Your expectations around about 1.8%.
Yes.
It's far short of that, Kevin. What's the reason?
Look, it's way below what we would have wanted. And obviously, ideally in this country, 1.8 is not acceptable.
Yep.
We need the growth rates well above that. There were a couple of factors that contributed. We're having a particularly bad agricultural season this year. Remember, last year we had a good season, but this year the rainfall hasn't really occurred in the key maize planting areas. So as a result, agriculture was down quite a lot. Manufacturing also declined. And manufacturing, yes, it's smaller than it was, but it's still a significant sector. and that was hurt by the electricity outages. So I would say those two sectors are particularly badly hurt. And then outside of those two sectors, most of the other sectors just seen no growth. By that I mean a lack of confidence, a lack of spending by consumers, a lack of investment by private business. So you just seen lackluster growth. Where we did have growth, and I think it's worthwhile mentioning, is that the platinum sector is going through a nice rebound now. Remember last year the platinum industry went through that protracted strike, and that was a huge knock to the economy. Well, what's happened in the last couple of months is the platinum industry has expanded production dramatically, trying to catch up for last year and build up a little bit of stock. So that was a big contributor, and quite frankly, without that platinum production, this number would have been a disaster. So overall, South Africa is struggling to move beyond the 2% growth rate. 2% is just not enough to create the jobs the country needs.
And as you said, we saw that graphic up a moment ago. Even among those sectors, each contribution is far short of what they had previously contributed, well below 1%. I heard a commentator say recently that if we didn't have the power shortages that Eskom has given us, we could probably see a growth rate of 3% this year. Is there any truth to that?
I think that's fair. I think there's no doubt that electricity is capping the potential growth rate now, probably capping it at around the 2% level. So literally it would be very difficult for this country right now to expand beyond 2%, because as we try to do that, we'd be using too much electricity and Eskom would have to do more load shedding, so that would slow down the growth rate. If we didn't have the electricity problem, prior to it, we were growing at a trend rate of about 3%. And at that stage, we were hoping or expecting to lift the growth rate to maybe 3.5% and try and see if we could approach 4%. That notion of being at 3.5% or 4%, that's gone for the moment until we get the electricity supply worked out. Then we've got to look at, can we raise confidence? Can we raise private investment? We have to be working on skill levels in this country and see if we can't employ more people to raise that. So for the next couple of years, and this is very sad about South Africa, we've capped our growth rate at around 2%, and we urgently need to find a solution to the electricity crisis.
All right. Now, a moment ago when we looked at that graphic, manufacturing contribution in 0.3% in the negative. You have the government embarking on this reindustrialization effort that they have. Would it even make a dent?
Look, it's not going to make a difference in the short term. It's very difficult to really boost manufacturing over, let's say, a year, especially when you're looking to create new manufacturing capacity. That tends to take a little bit longer than that. I think these programs are worthwhile if you consider maybe a 3 to 5 year type strategy, and if you've got the infrastructure in place, you've got the skills levels in place. So I think it's the type of objective we need to work towards longer term, but we've got to be realistic about what this country can now achieve. The game has changed for South Africa. So to me, the top priority is deal with electricity. Beyond that, I think there are two priorities we've got to deal with. One is definitely education skills that are applicable for what industry needs. And the second is we've got to lift confidence in the country, primarily amongst consumers, but also amongst businesses. We've got to make people feel more optimistic and start to engage positively with the country. We can't sit back and rely on the world to lift our growth rate. This idea that we could export our way to success, it's not realistically going to materialize in the short term. We've got to look internally, build confidence, and try to get past the infrastructure bottlenecks. That's not easy to do given the position we're in, but we need to see some progress.
Now, as these results were being released, Kevin, we have the Deputy Governor of the Reserve Bank, Kabir Naidu, telling journalists that we are likely, highly likely, to see interest rate hikes in the next few sessions. Bit of a conundrum here, I mean, because we've got low growth at the moment. What's your take on it?
Look, it does represent a bit of a conflict for South Africa because it sounds odd. You're hiking rates, which we know slows down the economy, at the exact time when the economy is incredibly weak and unemployment has moved up. The reason for this is that the Reserve Bank primarily has to focus on inflation. Inflation, we know, is at 4.5% now, so it's fine, but it's going to move up within a year and go above the 6%. The Reserve Bank has to forecast that. They're reasonably confident on that forecast. And interest rates work with a lag. In other words, once the Reserve Bank sees that inflation's going up, they've got to start to respond now, otherwise they can't combat it. So it's going to sound odd, and it's going to potentially hurt this growth rate even more. But the Reserve Bank's main job is to worry about inflation. We don't want to have a situation where we have the low growth and now inflation's running out of control. At least keep inflation inside the target range. The growth in South Africa has got nothing to do with interest rates primarily. It's got to do with supply constraints, things like electricity, skills, etc. So I think that we should tackle growth, not using interest rates, but using other forms of government policy.
And you've said this time and time again, the Reserve Bank alone can't fix the economy. Kevin Ling's always a pleasure. Thanks indeed for coming in.
Pleasure.
Now we'll take a look at more business news after the break. Do stay with us.